And thank you for joining us today. We'll leave a few minutes for everybody to be able to log on. But we're expecting a nice crowd today, and we've got a speaker that is sure to not disappoint. So very excited to have Sean Seguin from Fidelity Investments today to take us through our How to Weather Stormy Markets panel, and very timely given kind of the state of things for this year. So Sean's going to be taking us through some wisdom and through some lessons that the higher powers and the brains at Fidelity have put together. So some really great insights for times like these where markets are choppy. There's a lot of geopolitical and there's a lot of factors that are affecting investments. So Sean and the insights are going to help us put all that into perspective. So very excited to have that and have Sean here with us today. So I just want to say hi to a few of our participants that are coming in. We'll leave another minute or so for that. But hello, Christine. Hello, David. Thanks for joining us. Maurice, Jose, and Peter, thank you very much. And we're expecting a good turnout today. So thank you for sharing your lunch hour with us. Hopefully you've got some food, some drinks, and water or sparkling or whatever is on tap on your side of things. So I want to thank, we'll pass it over to Sean soon to do a quick intro, but I'll just give another minute or so for everybody to come in and settle in. And we do want to share that this is going to be an interactive webinar. So if you do have questions, there is a chat and there is a Q&A section below. So please feel free at any time to type in a question. We might even be able to pull you through on audio if you want to chat away that way. So happy to do that. We had a few questions that came in as you registered. So thanks for sharing those. We will definitely get to that. And as I let people come in, I'll pass it over to, before we do so, actually, we'll remind you who the team is. So myself in the middle, we have Per Homer, who's also on the line, and Jeff will likely be joining a little bit later at some point today to say hi. And then Ose and Leah, who help keep everything and running and the lights on, and who I'm sure you've had the pleasure to interact with or chat with if you are existing clients. So that's our team. And want to introduce our speaker, who is Sean Seguin, who's on the line. You see him in green, as you can tell probably by the graphics that he has behind him and the flags. A big Masters fan, and it's a great week for golf and any golf aficionados. So also later in the webinar, Sean will give us his predictions for who's going to win, if Tiger's going to make the cut, and you can take that to the bank because I'm sure he's following that very closely. So very excited to have Sean today. Sean, you can come say hello and welcome everybody.
I'm just going to throw in everybody. Sean, before you start, I'm throwing there that when we were in Mexico over March break, we had the luxury of seeing Tiger on the driving range, which is pretty cool.
In person. That's pretty cool.
Yeah, you're just going by the driving range, you're like, oh, that's Tiger. And he was hitting them pretty good. So fingers crossed he makes the cut.
Well, I know golf fans are excited to see him this weekend, but not nearly as excited as this group is to see Jeff Wachman join, I'm sure.
There you go.
Thank
Hey,
you.
Jeff.
Thank you, guys. I'm honored. I'm excited to hear what you have to say, Sean. There's a lot of activity out there in the past, I guess in Q1, Q2. You know, I don't have to remind everyone. I know that everyone is kind of well aware and probably has been a little anxious about it. So I'm it's very encouraging to hear from Fidelity, who I think has probably the premier research of any financial management company in the world, actually, for background research and access to research. So I'll leave it with you.
Is it over to me?
Yeah, it's over to you. Did I scare you?
No. Well, I thought that we were going to start with some Q&A and
Yeah. No.
Yeah,
So
I think the guys have some things they want to run through in some kind of organized fashion. So so with that, it'll be a great conversation, that's for sure.
Yeah. So the way we wanted to run today was we're going to ask Sean some questions that we've prepared, and Sean's prepared some slides for. And then as we go through, I encourage anybody that's on the line with us to also put questions into the chat or the Q&A, and we'll pepper Sean with those as well, and then wrap up around 12:45, 1 o'clock, so everybody can get back to not thinking about this stuff. But I guess the first one we had here, Sean, with everything that's going on, obviously we had inflation fears to start the year, and then we had Putin's invasion of Ukraine and the horrificness that we're seeing from there. Should I be worried about my investment strategy? That's the first question we have for you.
That's a really good place to start. It's always important that we look through the noise, and I've dealt with your group for a long time, Per. I think Jeff and I have probably worked together for 15 to 17 years. And the answer to that is it depends. So with this group, I know that you guys do very thorough financial planning. There's many investors out there who don't do full financial plans. So you're sitting at X spot, let's say you're 50 years old, you want to be at Y spot by the time you're 60 or 65. You've developed this plan, and it does help to retest it once in a while, but you don't want to retest it every day, right? Probably the worst thing that's happened to investors is access to daily market data and real-time news. So to answer your question, if the strategy, 99% of the time, the strategy should be set up as a long-term strategy. If something happens like inflation, like a geopolitical event, like, what is unfortunately transpiring between Russia and Ukraine right now, it might make sense to take a quick look and see, is there anything in this portfolio that I should be doing different? Typically, the answer is no, because most good advisors like yourselves have a well-diversified portfolio to test many different outcomes in the marketplace. Because if everything is working well in a portfolio at the same time, the portfolio probably is not constructed properly, right? So that would be my cautionary tale. If everything is working, that means, okay, if everything's working when rates are going down, then that means everything will do poorly when rates are going up, as they are now. So it's a long way to say you might want to, around the fringes, tweak a portfolio. But if the portfolio is properly built to begin with, which my sense is with your group, it typically is, then there's probably going to be very little need to change that portfolio. Your life situation might change, where you might need to change a portfolio. You might have an illness. You might have a life event where you inherit, or a life event where there's a divorce, or something to that end, where you might have to revisit the plan and rejig the plan quite a bit. But usually when there's outside events happening like we see now, there's always outside of events happening. You might want to sit with your advisor a couple times a year and just check in. How are we doing on these guideposts over the next 10 to 15 years? But generally, if the portfolio is constructed properly, there's not much need for wholesale changes.
Well said. I mean, one of the questions that we often get, Sean, is, okay, so there's volatility now in the markets, or there's an event. Should we, for example, last year we had a lot of, we saw growth really take off. Well, in the pandemic, we saw, we own a lot of global innovators, which was one of the best performing stocks during that period. But we do have some spikes. So we had the crypto spike. So there are a lot of different volatility pockets, call it. So a question that we often get is, when should clients change their portfolio? Should they change their approach if something flavorful comes up? Is that a question that you get often?
Definitely, Eric, most definitely. And I just want to pull up a slide to that end. If you have your portfolio built properly, it should have a little bit of everything in there. So, and I think we have something here, and you speak a little bit about it. Here is a great slide that shows, world events. So these are events that can scare people into making some changes in their portfolio. All right. So if we even just look back, most recently from, global supply chain disruption and inflation, the pandemic, there's always a reason not to invest. Always a reason not to invest. But what people might forget is that it's not, and we're going to talk, I suspect we'll have a question around timing the market a little later. Timing the market is very difficult, but you do have time on your side. So if you stay invested through all of these things, and I find clients like to go back to a year, they remember something specific. And geez, if you got out of the market, you missed out on something huge. There's some terrible things. There's some terrible things that go on in our world, but if you stick to that plan, you'll probably end up to the last place, to where you want to go. Now, to your point, Erik, are there areas where you might want to focus on? So in many of our, what we call multi-asset class portfolios, there would be different asset classes in there, which hopefully would accentuate things that people might want to invest in. So 5-7 years ago, it was cannabis stocks. All right, maybe 5 years ago, everybody, geez, I got to own a cannabis stock. All right. As it turns out, cannabis stocks for 18-20 months was a good place to be, but since then, not such a great place to be. They're turning out much to be like agricultural stocks as we thought they would be. But inside some of these multi-asset class portfolios, what we are seeing is, hey, we have some of that, or we've decided not to put that in there. And for these reasons, okay? So let me pull up another slide here, which will show you, here's, if you buy some of the multi-asset class solutions, here's what you might own. Here's what you might own at Fidelity. You might own, here's a good one here. You might own some US equity. All right, here. All right. You might own some US equity. You might own some Canadian equity, and all through the different markets. Now, right now, given where we're at in the economic cycle, we're starting to put more money towards Canadian equity and more specifically commodities. Why is that? Well, we've got supply chain issues with two big commodity producers in the world, Ukraine and Russia. And commodities tend to do well in inflationary periods. So two stress points right now that investors are most concerned with: inflation. Yeah. Commodities do well in inflation, right? And commodities should do well over the next little bit, because you do have challenges coming out of the Russia-Ukraine area. So I hope that makes sense. You want to be well diversified. I like to talk about, value versus growth a little bit. Erik, you mentioned it in your intro. There's different manager styles, even within Fidelity. Warren Buffett is seen as one of the better value managers in history. A former Fidelity manager, Peter Lynch, many people have heard of Peter. He was a great growth manager. So think of it as growth being your offense and value being your defense. And sometimes in the market cycle, growth is going to do better. And sometimes in the market cycle, value is going to do better. So for the last 6 or 7 years, growth has done better. The past 12 months, value's done better. But if you're all growth and doing great, when value does well, you really, really get hit. You want to have a little bit of both in a well-constructed portfolio.
Awesome. And, another thing that, we wanted to, because we prepared a few things here that we wanted to ask you about. I think a lot of the slides you have really speak to this, look, can we time markets? Can we say, we're worried about inflation. We're worried about the war in Ukraine. We're worried about a number of different things, or, whatever's coming up next. Can I time the markets, and how do I know when it's a good time to get in and out of the market, or when's a bad time to get in the market? So is that something we should be thinking about?
Yeah, that's a great question. And one of the most frequently asked questions I get from advisors and investors alike. So to just, to share with everybody on the screen, what my job is at Fidelity is I liaise with investment advisor teams like the one that I'm sharing the screen with today. And so I get questions from advisors who are doing this all day around, is it a good time? Isn't it a good time? most advisors get that timing the markets is very, very difficult. Sorry, I shared the wrong screen there, gang. I will get to it. Is very, very, very difficult. Market timing is very, very challenging. So that being said, how do we do it? Well, if you try and market time, you got to be right twice. All right. You got to be right on the way in, and you got to be right on the way out, which is very, very difficult. Now, there's a saying in the market. There's a saying that says, and I get it here, current slide, boom. We keep going back to that one. Sorry, guys.
That's okay. Just share it without the all the stuff around it. It's fine.
Good. There's a saying that it's all about time in the market, not market timing. So if you see here, and this is a crazy stat, and this is one that, I've been at Fidelity quite a while. I use this probably once a week with investors and advisors. And it really speaks to, hey, here is, almost 40 years, 35 years of data, right? It's, I think, 13 or 14,000 days, okay? It is a lot of days in here. And if you put 10,000 in and you just leave that 10,000, it grows over that time to 188. But if you miss just 10 days, just 10 days of time, and you weren't in the market, your return is halved. And that just shows you how challenging market timing is. Even at Fidelity, where we have arguably the most investment resources in the world, market timing, we realize, is very, very, very challenging, because you got to be right, getting out and getting in, or getting in and getting out. A new phrase that came to me during the early days of COVID, when we had one of the sharpest pullbacks in history, because the pullback was so short, but then the bounce back was very quick as well. But one of my colleagues at Fidelity came up with this phrase, and I love it. Just like we diversify our asset classes among, Canada, US, emerging markets, Europe, stocks, bonds, growth, value, we diversify that way. If you're really worried about market timing, diversify your entry points. So, if you get a year-end bonus that's sizable and you're worried about putting it in the market, let's say in end of January, you get paid. Maybe you diversify your entry points over the next 6 to 10 months. That might be a solution if you're really worried about it. But I also share one of my absolute favorite slides is really around markets going up and down. So if you try and, I'm going to sit on the sidelines until things get worse, and then I'm going to put my money in, think of a couple of things. If you're sitting on the sidelines right now, you're losing 6 to 7% in real terms, because inflation is 6 to 7, maybe even 8%. So you are losing money in real terms. Secondly, when things get worse, people are like, oh my gosh, things are getting really bad. I was going to get in if the market was down 10%, but now I think the market's going to go down 20. So you actually never get in. And then if we look at this slide, this is the whole enchilada. This is why we invest. So the odds of you getting it right by sitting on the sidelines are very, very low. And odds of me getting it right are very low. So if I had to share one slide today, it'd probably be this one, because this is, as I said, the whole enchilada. This is why we invest. So every rectangle here is a calendar year in the market. Okay. So in 2016, the US market, and I've got a Canadian slide here, it's almost the same. US market's a little bigger and has a little longer data. So in 2016, the market made almost 10%. All right. But why do we invest? So the bell curve, very good friend of mine in high school, the bell curve, if you put the midpoint of the bell curve, is right here. So your distribution of returns here, your average return is about 10% if you invest in the US market. If the average was 0%, we wouldn't invest. So the average is about 10%. And if you look, and about 7 out of every 10 years are up, right? So if you're sitting on the sidelines, but we don't know what years those will be. So if you're sitting on the sidelines, the market goes up about 70% of the time. We all remember the other 30%, but the market goes up about 70% of the time. So your chances of missing out on an up market is 70 to 30. So if it was 50-50, you wouldn't care. But like, think of the easiest game in Vegas is roulette. You get half black, half red. All right. Well, this is tilted 70% towards the black, 30% towards the red. And then the last thing I would point out here is the magnitude of the up years is much higher than the magnitude of the down years. And you just never know when things are going to turn. So 08's over here, and then 09 is somewhere over here, a big year, right? Like the pandemic started in March, and then the rest of that year was awesome. And then the next year was awesome.
Yep.
Right. So just when things, I hate to use darkest before the dawn, but sometimes when it's the toughest to invest is the actual time you should be doing it. So that's a 6 or 7 minute answer to your question, Per. Market timing is a very, very challenging. If anybody says they can do it consistently over the long term, you know what? They're probably not telling the whole truth, because if somebody in this world can do it consistently over the long term, there would be one investment manager in the world, and they would have all the money.
Yeah.
Right. So
I always say that timing is a mug's game, and it's not something you can count on. And so, like you said, diversify by time. So get in, if you have $100,000 to invest, put in a little bit this month and a little bit next month and so forth over 4 or 5 months, or spread it over some weeks, right? If you're a little more keen to get it in, a lot of people in the market will call that dollar cost averaging, but that's what I've seen in my 25 plus years, is that's the number one way to get into the market. And being out of the market is what's going to lose you money, not avoiding the market, right? So
well said. And emotions get in play. So you get people, selling here when they shouldn't be selling. This is where they should be buying, but it is really tough to buy here, right? Yeah. Because we're all emotional human beings, and it gets really, really difficult. And this, I don't want to oversimplify an advisor's job, but the most important thing as an advisor does is keep people from selling out here and keep people from backing up the truck here.
Yep.
Right? Because everybody gets FOMO here. It might be, and Erik, you talked about it a little earlier, it might be crypto. It might be, we believe in crypto long term. We did not believe in cannabis long term. We believe in crypto long term, but there's lots of things. It could be the FANG stocks, right? It could have been Peloton 2 years ago.
For the gray hairs, it could have been Bre-X, right?
Absolutely. Bre-X,
remember Bre-X, the helicopter?
Yeah.
How far do you want to go back? Nortel?
That's Nortel. The Bre-X movie, for those that haven't seen it, is a fantastic movie. Fantastic movie. You got to watch it. It was a bestseller.
Can I add to your kind of macro view, Per, just for those new investors out there? Not Per, Sean, I should say.
Absolutely, Jeff.
Because and Sean, your macro view is, of course, it's bang on, and we explain that, or you have anyways, over the years. But I think a lot of clients lose sight of the fact that there's a difference between speculating and investing. And we work with professionals like Fidelity because they invest in businesses that are designed to make money over time, and you share in those profits. So if the business is sound and there's a correction and people are selling the shares of that particular company because they're fearful, not because the company does not have opportunities to be profitable going forward, those are the times that professional managers like to buy. So either you understand that you own companies that are out there that are chosen because they've been profitable, or you don't understand that. But it isn't just simply I'm in the market or I'm out of the market. It's also a fact that I want to be a participant in the profits of the companies that I own. And that takes longer than 3 months or 6 months or 1 month or even a year sometimes. So you need to diversify a portfolio so you have sources if you need to take money out that aren't impacted by small volatility issues or large volatility issues for that matter.
Well, and Jeff, you bring up a good point about being in the market. So one thing that I always caution investors, especially relatively new investors, just because you're invested in a mutual fund doesn't mean you're in the market.
Right.
You might be in the market. It depends what market. But if you have, traditionally pension funds are 60% equity, 40% fixed income. So teachers, OMERs, CPP, that would be their asset allocation. And then individual investors, if you're a little more aggressive than, let's say, your average bear, you might move to 70 or 80% equity, 90. If you're a little more conservative, you might move from 60 equity to 50 to 40. But when you say you're in the market, people just assume they're in the stock market or in the equity market. But most people are somewhere between 40% and 90% equity, which means they're only 40 to 90% in the, when people talk about the market, 90% of times they're talking about the stock market, not the bond market.
Right.
Right. So even though you're in the market, you might only be 60% in the market. Now you're in this, this type of balance, the global balance portfolio, which right now is about 65% in the equity market. Right. So if you're in the market, you need to know you're partially in the market, but maybe not 100%. If you own just bonds, you're in the fixed income market, but you're not in the stock market. And there's a big discrepancy there. For good reasons.
Oh, go ahead. I want to pull on one thing. You mentioned the global balanced, and one of the questions that we often get is how can I make sure my portfolio is built to weather all storms, so to speak. And how we like to think about it is we like to adopt a core and explore model, or a base and specialized pizza toppings in a sense. So we often like to use a base, for example, Fidelity Global Balanced. So just wondering if you could kind of maybe open the hood and peel back the layers to the end. And so to explain to investors and to clients how it works on that side of things. I mean, say we work with a professionally managed portfolio, such as a Global Balanced as a portfolio base. How do the managers take what's going on in the industry, and how do they make their decisions to help protect clients and build that weathered portfolio?
Yeah, good question, Eric. So, and I'm sure a number of the clients on this call own our global balanced portfolio. So I'll use it now. So we have, hundreds of portfolio managers and analysts, which are like junior portfolio managers around the world. I think we operate in 40 countries, biggest offices being Boston, Toronto, London, and Hong Kong. But when we build this portfolio, people might see global balanced portfolio on a statement and think it's one person running it. But it is a team of hundreds around the world. And the way that starts is we have an asset allocation team. So think of them as the teacher of a sports team. And they, meet maybe, they look at a lot of data. I know Perry used to work with individuals like this in his previous life. They look at a lot of data, economies around the world, employment rates, inflation rates. They will talk, at Fidelity, we're big enough. They will talk to the head of the Fed. They will talk to the head of the EU. They will talk to the head of Bank of Canada, and they formulate a view of what they think is going on in the world. And then they build the portfolio. So they might say, we really like emerging markets. In the portfolio we have, there is a baseline. So the baseline is 60 equity, 40 fixed income. And in that 60% equity, it might have, let's say, to keep it easy, 20% Canadian, 20% American, and 20% international stocks. And given their global view, they might decide to slightly overweight Canada, slightly underweight international, maybe market weight US. And then within there, the way they do that is pick individual managers at Fidelity. So think of them as the students or the players on the sports team. And they might say, okay, we think right now, we don't know if value or growth is going to do better. So on that 20% we give to US stocks, we're going to give 10% to a growth manager and 10% to a value manager. That's a little oversimplification because we have a lot more mandates than that, because then they might do, okay, we're going to do growth, small cap growth, and we're going to do large cap value. But as you trickle down from that global asset allocation team, as you trickle it down, it's going to specialists in each area. Okay, if you have bonds is a huge marketplace. A lot of people don't realize that the fixed income market is 10 times the size of the equity market. So what type of bonds are you going to hold? Are you going to hold high yield? Are you going to hold TIPS, which are treasury inflation protected? And we have different managers in each one of these, and we call them internally sleeves. Every sleeve of this portfolio, so it's very well diversified. Even though it says global balanced portfolio up here, it is very well diversified as you go down towards the bottom of the pyramid. And then the portfolio managers should be, portfolio managers will be on a daily basis tweaking that on your behalf. So right back to the first question that Erik posed, you know, there's always going to be world events going on where people think we need to tweak our portfolio. That's why you hire us, right? That's why you hire us, this team as asset managers. We will be tweaking the portfolios behind the scenes, and we might be doing it, you know, there might be a time between 10 and 11 this morning where high yield spreads move 20 basis points or 30 basis points and made it an attractive entry point or attractive selling point, just on the fringes for that manager. So they might have done that in the portfolio and we don't even know, right? Because we get paid to manage emotions, set up the proper portfolio for you all on the call, who have, each one of you has a little different scenario, right? There's no plug and play for every client. But that's what the portfolio managers, that's what they're doing. They have very little vacation. They work 80 hours a week. Our young guys, they start at 23, 24. They don't take a vacation for 2 years. Like, that's what they do. And they love it. Like, don't feel bad for them. They absolutely love it. And so that what's happening behind the scenes, you don't always see, but things are getting tweaked all the time. Now, do they try and make a big bet? We're going all equities, all in the market and all out? No. That goes back to what I said earlier. Market timing is really, really tough. But on the fringes, they are trying to massage the portfolio in a way to take advantage of small dislocations in the marketplaces, because the market isn't always efficient.
Do you have that? You know, you usually show a great slide of what they're thinking. So that I call them the two Davids, because there's two managers in that fund, David Wolf and David Tulk, and I personally have known them for longer than I care to admit. When we were all on Bay Street, as it were, instead of in dealing with individual investors. But they have Sean's got a great slide that you usually show relating to that portfolio, and shows the different, you know, just to further highlight what you're saying, shows the different levers that they can pull, right? And how it formulates their thinking about, you know, the different asset classes and so on. So hopefully I've stalled long enough now for Sean to pull up that slide.
Yeah, I'm trying to find it here, Per. I'm trying to find it here and see, because I know I do have it. It's just not.
While you're looking, is that chart on the shutter a latest chart from one of your managers on the shutter behind you?
That's a master's flag.
Yeah. Oh, I think so.
Yeah, it's a master. Yes, it is. I just put it back up yesterday. Okay, there's what I'm looking for. So let me get to the share screen. I'll actually autographed by two-time winner Ben Crenshaw. Oh, here's what we're looking for. And I was doing a presentation with somebody in your office today. So I think this is what you're referring to, right, Per?
Yes.
So this gives everybody a little idea of, and man, this is well, I love to do these in person, gang. This is something that we can do when we meet virtually. You can pull this stuff up. It's so handy. So as I mentioned, global balanced, and FMP is just an acronym, Fidelity Managed Portfolio. So this sets 60 equity, 40 fixed income. So if you read the prospectus, which is a legal document, says what this investment should do, it starts at 60-40, but it almost never sits there. Almost never. So right now, we're a little bullish equities. So you can see we're at 66.4% equities, right? Last year, this was as low as 61, as high as 68 or 69. But the fact that we're slightly overweight equities is we think stock markets, 6 to 12 months from now will be higher than they are now. Okay. And then underneath that, okay, where are we overweight? Where are we underweight? So we used to be a little more underweight Canadian equities, but we bought into Canada a little more. So our underweight has been reduced. We think commodities, we're very overweight commodities because in inflationary times, you want to own commodities. So these commodity producers would be elsewhere in the world. If rates are going up, you just do not want to own these types of bonds. It's been a very, very challenging year for the fixed income market year to date. After 25 to 30 years of good fixed income markets, when rates are going down, rates started going up. So most investors have never lost money in bonds, but the standard fixed income markets, investment grade fixed income markets, are down 7 to 8% year to date. And usually fixed income provides, some layer of safety, but when rates are going up, it's a little different story. But some people forget those days. I mean, you have to be a relatively older investor to remember last time when rates were going up like this in the late 70s, early 80s. Where we do play on the fixed income side has been TIPS, which is Treasury Inflation Protected Securities, which go up with inflation, and floating rate, which has been very good this year. So this gives an example of how our people move money around, and the triangles, the diamonds show where they're positioned. I think usually 6 months ago. So you can see how they move it around. They've reduced cash because they don't want to sit on too much cash because that can be a drag in the portfolio. But this shows what's happening on your behalf, gang, behind the scenes. So you say, should I tweak my portfolio? People are tweaking your portfolio on your behalf. Is that what you kind of wanted me to hit on, Per?
Exactly, especially that last sentence, because what we need to understand is that we're in the business of picking managers who we believe in and we believe will have the right choices to drive our returns and our portfolios going forward. And within those balanced funds, they are not static funds where they just hold the same stuff all the time. They're able to go in there and, like, you see these different, what I'm calling them levers, you can gear up on this side and slow down on the other side, and it allows them to tweak the portfolio as things go along. And I can tell you that this slide looked different in December than it looks now, and it will look different again 3 months from now. So thank you, Sean. That was exactly what I was looking for.
No problem. And it's only good for you, gang, as investors, if we get this right. And at the risk of tooting our own horn, so we make those changes, but if we're wrong, it's not great for you, it's not great for us. But you can see here, we've got a range of different portfolios from, more conservative to more aggressive. But the one consistent theme is independent rating agency Morningstar rates them all 4 and 5 star. I mean, that's not the be all. It's not the be all and end all, but it is a good place to start.
It is, yeah. All right. Well, I think we've taken now about 40 minutes of everybody's time. Erik, do we have any more questions on the docket, or are we? I don't think I see any.
I have a few that I jotted, but maybe we can go rapid fire. And at this point, maybe we also throw it out to the audience and encourage, if you do have any questions, hearing Sean, Per, myself, and Jeff share our thoughts, please do feel free to use the Q&A, the chat. This is your time. We are live, so might as well use that interaction.
Erik, maybe I can just say one thing regarding the kind of humanitarian crisis going on in Ukraine and Russia, because in our minds right now, and we don't want to sound flippant, inflation, when it comes to investing, when it comes to investing only, inflation is our number one concern. But headline news right now is more around the Russia-Ukraine conflict and how will it impact markets. And we get this question 6 or 7 times a day. And if I really had to, I'm going to oversimplify it, but it just helps people get a little perspective. The news is super disturbing, but think of yourself as a consumer or a business in North America. All right. Consumers and businesses around the world are largely unchanged. So if you're a Tim Hortons person or you're a Starbucks person, or you make your coffee at home, you're still probably doing the same thing in the morning, right? You're stopping at Starbucks, you're stopping at Tim's, you're brewing yourself a cup of coffee. You're probably still going, you know, usually Tuesdays I go to Subway for lunch. I like the Italian BMT, right? When we get done this, I'm going to Subway to get the Italian BMT, right? It hasn't changed that much. Typically with geopolitics and conflicts like this, the closer you are geographically to that conflict, the worse things are. Now, in most of the investments at Fidelity, we own very little Russia and almost no Ukraine, okay? So for those people there, it is terrible. In our view, this is probably not going to change into World War III. If that's the case, we have a few bigger issues, all right? Maybe you're buying defense contractors, that type of thing. But when it comes to that conflict, the investment themes that come out of that is, I don't think anybody on this call, maybe some people did, but like I didn't realize Ukraine makes, you know, is the top 5 supplier in so many different natural resources in the world, whether it be fertilizer, minerals. My wife, who's working right here, she knew a lot of this stuff, but you know, so a lot of the things, whether it be forestry, minerals, oil, natural gas, are helping Canadians. So we're investing in that theme. Wheat, great pair. So more to come on that. Hopefully there's resolution over there, but like you know, the news is disturbing, but consumers and businesses in the majority of companies that we invest in are largely unchanged.
Yeah, I'm glad you brought up Ukraine. I mean, you know, there's so much that Ukraine contributes to the world's economy and to just the world in general. I don't, like you said, I don't think it's going to change, you know, the economic outlook massively unless we head towards World War III, in which case we have a different ball of wax to deal with. Probably a good time to give a shout out to Jeff. Jeff started an initiative last month whereby Jeff said to all our clients that if you want to donate to Ukraine, Jeff will match it. And Jeff, do you want to mention a little bit about how well that went? I think, you know, if we're talking about Ukraine, I think we want to talk about how
Sure.
The team has helped.
Yeah, I mean, I just gave people the opportunity, if they hadn't contributed or felt that they wanted to and needed, you know, just some matching incentive. We had over $1,000 or close to $1,000 from clients in the space of a week, and then we matched it. So we're just under $2,000 that we sent to the Red Cross and other humanitarian aid groups in the Ukraine, which you know, it gave us the sense that we're doing something to help their plight, and it's just so disturbing to see on the news. So, you know, you know, anyway, we're hopeful. We're all hopeful that that this is resolved in a way that we can all live in peace.
Yeah, and the good news about that too is that we know that the Canadian government as well was matching donations to the Red Cross. So whatever was donated was matched by Jeff, and then further matched by the Canadian government. So a lot of doubling up, which is fantastic and
very cool.
Absolutely,
it's very concerning. So thank you for bringing that up, John. That's a good segue. It was not a plant, so thank you. Yeah. Erik, I'll throw it to you.
Okay, we'll go rapid fire to finish off here. I don't see anything in the Q&A or the chat, but a few things that popped up through this, and I wanted to open up to you, Sean. So you take any and maybe give 30 seconds or a minute of thought. So I'll give you a menu and you can pick any which way. We mentioned crypto, that's 1. 2, insights from PMs. We have some favorite Schmel, Tillenhast.
Let's go in order. And you know, we'll pretend we're a morning radio show. Maybe I'll have to pass and come back to one. But crypto at Fidelity, we believe in it. We've been operating in crypto for over 10 years. What a lot of people don't realize about, we've been around for over 75 years. We're Boston based. We're a very conservative firm in many ways. But we have a big technology arm that, hey, when you think of crypto, here's the things you need to know. It's super volatile. So you want it as a bigger portfolio. To give people an idea of the volatility, the TSX, if you just buy 100% stocks, has a volatility of about 15. Crypto has volatility of about 90. So that's 6 times as volatile. If somebody wants some, I say buy 1% of your portfolio. And the first time it really, really drops, if you hang in there, then we can give you 2%. But other things to keep in mind about crypto, it is limited to 21 million coins, the supply, so limited supply. The amount of crypto that is issued, new crypto gets halved every 4.5 years. And, even as an inflationary hedge, gold hasn't performed as well recently. And most people think that's due to crypto. So we think it has a place in this economy. And to such an extent where in some of our portfolios, we're putting 1 or 2% of crypto, because we think that's the way investors should own it, is as a small piece of a bigger puzzle.
So Sean, my question to you is crypto a currency, or is it a precious metal or a precious?
We think it's a currency, and we will see.
How is it being used as a currency?
So people, that's a great question. It comes back to investing. So if you own and store your crypto on a personal device, you're using it to buy and sell and transact, I hope. If you have it with a custodian like Fidelity, you're using it a little more as a precious metal and an investment vehicle. Okay. So, and I don't know the demographics of everybody on the call, but almost every person I know in Toronto knows somebody that has lost crypto off their hot wallet because security is terrible. People can hack it, you lose your phone, you lose your pass key. And so where we're seeing a lot of money flow to in our crypto investments is I've got, I bought 3 coins at 10 grand each, 30 grand. Now they're worth 120 or 130. That's too much to store here. I cash out, I give it to my investment advisor, Jeff Wachman, and he puts it with Fidelity, which has cold storage and very good storage. That's more of an investment, a precious metal type of investment. Mm-hmm. But maybe I kept 1 coin on here because I want to spend it. All right, because I want to spend it. Yeah. So that is the biggest difference that we see is between those two things. And quite frankly, I'm surprised at the amount of money that's flowing towards our crypto investments. But as I call advisors and say, where did this money come from? Almost every advisor is saying, I had a client who was really worried about security on their hot wallet. They want better storage. All right. So big learning for me. I don't own any crypto until maybe 2 months ago. I didn't know the difference between hot and cold wallet. And that's all the world of difference.
Interesting.
And what's interesting is as I talk to a lot of 30-year-olds downtown, obviously I'm a little older than that. Every person will say, oh yeah, I had some friend who lost some crypto. It's amazing.
Yeah.
It's amazing.
And what in the crypto space, what are the names that come up constantly?
Bitcoin, first mover, Bitcoin and Ethereum, and then everybody else.
Yeah.
Like you will see from us probably a mix of you'll probably see an Ethereum investment come out soon, and then maybe a mix of cryptos.
So unfortunately, you can't pay for anything that's valued in Bitcoin. All you can do is convert it to a fiat currency. at the time you want to buy something, because everything in the world that we live in is pretty well quoted in fiat currency because it's less volatile, correct?
Correct.
Okay.
But you can still pay for it in Bitcoin. You just have to.
You have to do the
it's
conversion.
like having a US dollar in the Dominican, and you got to do the conversion, right?
Right. Okay, gotcha.
All right. Real fast, you got 2-sentence answers to the rest of the questions that Erik has. Ready, set, go.
All right. Any words of wisdom from some favorite PMs? Shmel, Tillinghast, anybody that you've listened to recently?
It's a value market until otherwise noted. So a lot of our growth managers like Shmel have moved their tech investments to value until further notice.
That's
Great.
encouraging.
Yeah.
Okay, one more quick one, then we'll get to a fun one. For clients that might be on the sidelines and are worried about inflation, generally we'd say phase into your portfolios, but are there other solutions out there that we might want to consider?
Fabulous question. We, and I'll take a step back. I got this from the oldest advisor that I work with. And he's like, you know, if you're sitting in cash, you're losing 68% a year right now in real terms. So don't sit in cash. Our asset allocation team that I showed you pulled those levers, and Per asked me to pull up that slide, which showed you where they're overweighting and underweighting. This time last year, they asked us to come out with an inflation focused mandate, which we did. And it was out by about Labor Day. So it's been running now really, really smoothly. And it is the only product that I know of in Canada that has asset classes which do well in inflationary times in a nice little wrapper. And that is somewhere where you want to consider having anything you have in cash right now, because if you have it in cash, you're losing 68% in real terms.
Well said.
Okay. Yeah, inflation is definitely a factor. No question. No question.
Last one I had is, what are your top 3 Masters predictions? Going with the theme
It's
today.
going to be fun to watch. I will get in trouble with my wife for watching it too much and not carrying my load with my 5 and 7-year-old daughters. And I'm going with Justin Thomas to win it all. So those are my 3.
JT. Okay.
Who, and then last question, who is the player with the most Masters victories?
Oh, that's easy. The GOAT, Jack.
Yeah.
There you go. Thank you. Good.
6.
Followed by
Tiger.
and then
At 5. There's a few of them at 4, I think, isn't there? Arnie.
no, just one at 4.
No,
Just Arnie. Just Arnie.
Just Arnie.
Yeah.
Okay.
Arnold Palmer. There you go.
Very good, Sean.
Well done, Sean. All right. Well, you get to come back. You have
Okay.
As Tara likes to joke, don't ask me my wife's phone number, but I know those things.
there you go.
Uh,
All right. Good.
Thanks for having me, guys.
know-
What a
Well,
pleasure.
okay.
Sorry, go ahead, Jeff.
The NCAA March Madness tournament that was just won by
Tar Heels.
No,
Girls or
sadly,
men's
not
or men's or
Tar
men's.
women's?
Men's.
Men's. Last night, Kentucky won.
No, not Tar Heels.
No,
Much
it
to
was
my, much to my
Kansas.
chagrin. Yeah.
Kansas won.
Kansas
Jayhawks.
U.
Oh, sorry, Kansas won. Yeah, Kansas won.
Okay, so what's the
Jayhawks.
chant? What's the chant for Kansas U?
Chalk Talk Jayhawk.
What? Rock, chalk, Jayhawk.
Okay, I was close.
Very good, Sean. I swear to God, I'll invest with you now. What don't you know?
All right. Well, yeah, I want to thank Sean.
My wife's phone number.
Well, yeah, we don't need that. I don't think she wants us to have it, so it's fine. Sean, I want to thank you very much for joining us and kind of in this free form, rapid, quote unquote, rapid fire presentation. You know, I know we put you on the spot a little bit, but really appreciate all your insight, answers, and thoughtfulness. You know, and obviously we have fun when we talk. So, you know, thank you to Sean and the Fidelity team for supporting the WWH Financial Group team. Thanks to Jeff for your generosity to the people of Ukraine, and to, you know, Jeff and Erik for the great questions that you asked. And thanks to our team for all the hard work everybody does. So
Thanks for having me, gang. Have a great
thanks very
spring.
much. Okay. And everybody stay
Enjoy your
safe.
Subway
And
sandwich, Sean.
thank you.
Well
Yep.
deserved.
Now I'm hankering for one too. Cheers,
Ah,
guys.
Thanks,
okay.
everyone.
Be well.